All right. Good morning, everybody. The AM edition came out right when I was starting, so I was getting it downloaded. Then I can put it in the chat. We're going to get some more inflation data, but it's missing some of it, right? It's going to be for import prices, and it's kind of a backdoor into inflation, and it's delayed. So it's not going to really capture what Trump had kicked off in the last month. So the forecasts are really low. If it happens to show up a little bit in here anyways, the market might respond to that. We can see the previous 0.4 and the median forecast at 0.1 on import price index at 830. Let's just see how it comes through. We've got some Fed speakers today. We've also got European Central Bank President Christine Lagarde. So it's going to be fairly busy. Just keep your eye on headlines, of course, and we continue to monitor what's going on with the dollar and the yields. The Bank of America earnings is like the last shoe to drop when it comes to the collective start of the earnings season. Each one of those four major banks has something that they get to represent. So for Bank of America, this is like the average retailer, their average consumer, whether they're spending their credit cards or buying a new vehicle. And if you caught any of the Bank of America earnings, their earnings was their earnings outlook was relatively positive, suggesting that their clients are continuing to spend. They haven't backed off all that much. They're not seeing indications, of a significant slowing or changes in behavior. We always talk about how banks set the tone in the earnings season. And if they come out really negative and talk about a slowing and a change of behavior in the clients that they represent as a group, it tends to set the tone for the whole season. And now that we're done with the four of the biggest groups, the tone seems to be caution but profit. So we'll see what that translates to. Let me get this thought gamma note shared over. Obviously, it just came out. I haven't had a chance to read it, so you'll have a chance to see it before I do. All right, we got the put wall 5235. We're still above that. Zero gamma volatility trigger and call wall overhead. volumes coming in a little lighter this week compared to last week. We were in the hundreds, and now we're back into double digits. This is not light volume, only light compared to what we've seen in the last 2 weeks or so. Generally speaking, we should typically see something between 45 to 65, maybe 70. So we're still above the average, whether the average is a 6-month average, 1-year average. It's still elevated. You can see the red line, which is the average, kind of a generic average that I've put into the formula that built this indicator over the years. It's trending back down, but it's going to take time, right, to get back into a more normalized state. As we've talked about recently, we need to get through this high. It's the really big bar from April 9. That really big bar is the bar in control. We need to get through that if we're going to set a higher high. And we've got a little bit of a pinching formation going on here, trapped between the 20 period and the 10 period. Now we're starting to get that surge signal where price crosses through the two moving averages, the 3 and the 10, and then the 10 crosses above, or the 3 crosses above the 10. That's the surge signal. But the other piece of that is it has to continue to drive upward, and we're not doing that. We're stalled out. So this is forming compression, and the compression, like anything in nature, will explode if you press it too hard. That does not offer direction, right? There's no bias to that to say it's bullish or bearish, just that it's going to have a lot of energy when it finally does make a move. Looking at the average daily range, we've got another day where we very likely won't hit either edge unless we get some sort of news that kicks things off. It seems we're hearing a lot of getting everything getting dialed back, right? It's reduction in threats, reduction in tariffs. They were using a word on Bloomberg yesterday, and they were asked not to use that word. Like, for the life of me, I've been sitting here trying to remember this morning, and I can't quite grasp it. I thought it was a reprieve or a reduction and something like that. And they said, no, we don't want to call it that. Well, it doesn't really matter what you call it, right? Tomato, tomato. If you draw a line in the sand and then you come by later and you draw a different line somewhere else, then, you start to have a bunch of lines all over the place. Nobody knows where they should cross, where they shouldn't cross. The uncertainty is one of the things that has fueled this sell-off, and uncertainty is one of the things that continues to hold us back from coming out of this sell-off. So we need clarity, we need guidance, we need numbers that don't change, facts that stick around for a little bit. And if we continue to see uncertainty, then it's very likely we're going to continue to fail to get back up to previous levels. For today, we're still inside day. We're inside of yesterday's range. If we get out of that range, then we've got the ADR half. If we get bullish in one direction, we'll reach the yellow line. If we get bearish in one direction, we'll reach the yellow line on the other side. It's pretty simple on that aspect. The idea is what's going to spark the move to get us outside of yesterday's range when the entire market seems like it's waiting on something. And it's a short week too. It's hard to see, a bunch of traders wanting to pile into risk in front of a 3-day weekend on a short week. We have VIX expiration tomorrow. And then we've got jobs data and OPEX on Thursday, which will be the end of the week. All right, today's floor pivot is higher than yesterday. That's considered bullish. But price opened underneath it, and that's considered bearish. Those two kind of cancel each other out. We're still above the weekly pivot. And yesterday we did not hit the floor pivot, which gives us an MDP. That's a missed daily pivot. It doesn't count for yesterday. It actually counts today. So today we're working in a missed daily pivot condition. We've hit today's, obviously, so we won't get back-to-back missed daily pivots. And that's a little bit of a tell, too, if you've gone through any of the material from, I always forget his name, Rob something. I don't know. It's not my strategy. It's not my analysis. If you look up missed daily pivot on YouTube, you'll find the guy that really promotes this idea. I don't trade it as a strategy, but I do find it useful for analysis, which is why I bring it up. It's why I use it in these streams. So if you would just want more context on that, go hit YouTube with missed daily pivots. Today is a narrow channel, which implies if we do break out, that we likely get a good run out of it. Yesterday was a narrow range day. It's an NR1. So, you know, we haven't been tightly wound for very long, just that one day. We'll see if that's enough. And the breakout that we're talking about is just yesterday's range. So it's not like we have to get outside of that really big bar from the 9th that we were talking about a few minutes ago. All we have to get out of is yesterday's range. That's it. It's not a very tall ask, right? 100 points from 5,400 to 5,500 GTFO, and we've got a chance to run. Now, to the upside, we've got options levels of concern and bigger moving averages to hit. To the downside, we've got the weekly floor pivot and then last week's low. Even Friday's low. If we get through Monday's low, then we have Friday's low and then the week's low of last week, along with the weekly pivot. So we've got structure on either side. The base case argument for the week is that we really weren't expecting to go anywhere. Of course, news can always change that. So maybe a headline kicks us out the door. But other than that, what's the fire to move us today? We just went through the economic data. Nothing really stand out there. So we're talking a headline that we can't anticipate at this point. That could kick us out. We could get 0-day options flows, but we can't see those here in the pre-market. It could be a coordinated effort between the Mag 7, the hyperscalers, some of the risk-on areas like Bitcoin and finance, consumer discretionary technology, which we'll get to once we're done cycling through the ES. And or it could be treasuries. But at this point, it's got to be something because the ES isn't going to do it on its own. After the moves we've seen recently, this week's very narrow profile stands out. It is a classic D-shaped distribution. We are below the point of control and headed to the downside, nearing the edge of the value area low, which would be this 54.25 area. But this is the classic shape. If we break this value area low, it's likely that we retest that 53.92 cog line, which would be last week's point of control. It doesn't owe us that, but there's nothing to catch us down here, right? From the profile's point of view, once we get below that value area low. Now, last week's profile is not a classic distribution. So if we get through that point of control and we continue to drop, it gets shallow, then it gets thicker around this 52.65 area, shallow again into 5,000. Now that's getting into some pretty nasty stuff. It's hard to believe we would fall that far unless the headlines are really bad, right? An economic data point wouldn't do this. It would have to be more than that. At least no economic data points that we have on the calendar this week. I think that's a better way to say it, right? Because certainly economic data could make us take that move, but nothing that we have on the docket this week. I think that's a more accurate way to say it. $10-day, 30-minute volume profile with TPO. We are now working on these candles. So this point of control is going to move by the end of the day. Very likely before the morning even really gets started, it's going to move. If we pop back up into that 54.92 area, the point of control will end up right there. All right, it'll get moved down to the next highest volume profile. Now, if we happen to break yesterday's low and get into Friday's zone, then that 5,300 area stands out right down here. We could put in some more work there and see that expand far enough to get the point of control. Otherwise, the level that built this starts way back here, and we're not going to see that get hit till later in the week. Then we put in more volume, more work there. So those 2 points would have to get hit to wipe this volume off the board. So if we don't go there, it'll be because we build out some volume somewhere else. If we can get up into that zone and put in even more work there, we could build this out farther and give us a more guaranteed level. What would be nice if we can get to 54.92 cog line, it'd be above this. We would have put in some work to get above it, so we'd have more volume standing out. And then that point of control gets moved down and it's underneath us, acting supportive rather than continuing to be over our head, acting resistant. We hit the VPOC from Friday, so that's done in that wick down yesterday. And for today, we've really already hit it. Now, look, the textbooks will tell you to carry forward yesterday's point of control. Doesn't matter if it's been hit or not. That's what the books really kind of focus on. So here's yesterday's point of control. And they would tell you take that line and carry it forward into today. Always. I've got enough lines. I don't need it. So I'm not really interested in it. I generally only mark the ones that have not yet been hit. And we're looking at Monday here, even though it's zoomed in, it's kind of ugly, hard to see. That's Monday's point of control. We hit that this morning already. So I don't have any interest in marking it as a VPOC at this point. If you want that pivot point, because it's what the textbooks would tell you, you're not wrong in doing that. It's not a bad way to go. I've got enough pivots. I don't need another one. The books will also tell you, incidentally, to carry forward the value area high and the value area low as well. Whatever. You do you. So no VPOC from yesterday, although not by much. And there are analysts who will argue, oh, well, that was a pre-market tap and they would want to see it hit again in regular trading hours to consider it a valid hit. Since we basically tapped it, really didn't close above it, didn't, continue to go higher through it. It's a valid argument, a case to be made that it still has relevance today, which is the entire idea of marking out these levels in the first place, right? There's no magic to them. It's just some idea that there could be unfinished business at this level. And if price goes back there, we would want to have that reminder on the chart as a line that we could see more unfinished business or more responses at that level. Makes sense. We're still above the 10-day, but we are in this narrow zone above and below the 10-day. It's about 0.5% in either direction that we consider a bit like a magnet or gravity. If we get too close to the 10, we can end up just crossing back and forth through the 10, not as a support or resistance, but more of just this level or zone that we can't seem to escape from. And the longer we hang out at that level, the more options get built on either side, kind of starts to box us in. And we just got here. We haven't been here for long. We are in that zone, and we do build up energy while we're hovering around that 10. If we look at how things are going for the week, the white line is Friday's close. This is the week's range. And as you would suspect, we haven't gone anywhere. We haven't done anything. So we've got plenty of room to move if we did want to make a move without being considered overbought or overextended or oversold. Nothing that says we've gone too far, too fast. On the daily, it really looks like we're healing nicely if we're just looking at our distance from the 10. Looking at the price action, yeah, we're still broken. We're still 3% below the 10-week. We're moving in the right direction back towards the 10. And get back to the 10-week. The concern is that we're going to end up with one of these cycles where we started to move towards the 10 and then we fell back away from it again. We want one of these cycles where we actually complete it, get through the 0 line, get above the 10, and then if we have to, get back down below the 10 again. As ugly as this is, it is a wave. We are crossing up through the 0 line back and forth. So we're on the upside slope, moving back towards 0. All right, this changes over a 5-day period, and we've got the top 9 sectors. This isn't all the sectors, but it's the top 9 that we generally look at. The 3 on top are risk on, the 3 on the bottom are risk off. 3 in the middle are what we consider a midline. So in a slowing economy, when jobs are scarce and companies are dialing back, we tend to see the bottom row do better. And in an economy where people are spending frivolously and extravagantly, companies are doing good, they're hiring more people, they're putting out great products and having good earnings, then we see the top row do better. This is the growth versus value concept. And it's not the idea that if growth is doing well, then value isn't. They can both do well at the same time. We're just looking at which one is outperforming. Is growth outperforming value or vice versa? And we can see, looking at all of these, that they're all green. They're all moving up. They're all doing good. So we're not rotating from one to the other. We're seeing a rising tide lifting all boats. So a very high correlation coefficient where everything is moving in the same direction. And yeah, I get it. It's early in the morning using big words. In some of the most dangerous market conditions is where we have these high correlation markets. Because like a herd of elephants, get everything moving in one direction, it's hard to get that to stop or to turn. So for right now, that move is to the upside. If and when that changes or flips, it's very likely to be very violent to the downside. So just be mindful of that. And like we've talked about before, if we're looking for this pattern, at this point, maybe we've got our higher low. Maybe. But we need to resolve this. And if we're trying to work our way back up, it should be a higher high. Otherwise, if we drop down and we break this, then we're looking at setting a new lower low after just having set this higher low. And then we're just building out a more complex bottom. What we'd rather see is a higher high and then a pullback, right? Because nothing is supposed to be a straight shot back up. Set a higher high and then pull back and set a higher low and then run up and set another higher high, breaking this high and continuing to move to the upside. So we still want to focus on that 5,500, getting above that and putting in that higher high before we come down and break this 5,300. Looking at things that are down this morning, benchmark with 0.5%. Nat gas is really the only thing on there. These double, triple leveraged products, I'm not really all that interested in focusing on. And to the upside, we've got Bitcoin and VIX, basically. So everything else is not up 0.5% or not down more than 0.5%. It's a whole lot of market waiting on something. We don't want a rally based on pot stocks and gold miners and Bitcoin. Although I continue to argue Bitcoin is a really great proxy for risk. And yesterday we saw some good moves in the Bitcoin space, right? They were getting attention. Riot, Mara, Coin, Hut, Hive, all those guys were getting some flows. It's a decent tell to keep your eye on what crypto is doing just as a sentiment of risk. Now, I know others use it as a liquidity tell. I'm just more interested in the risk side of it, risk appetite. So this is my crypto list. You may be surprised to find things like NVIDIA in it, or AMD, PayPal, Square, but that's just the way it is. This list was put together by breaking apart the Smalls Exchange Bitcoin product, right? Which is a basket of stocks similar to an ETF. I opened that up. I took the names out of the basket and I built my list from it. So while some of that Bitcoin names are up this morning, they're not looking very good. And they're also still inside of yesterday's range, much like the rest of the market. So, if we want that to change, then our leaders need to break out of the box, get outside of yesterday's range, and really get some work done. Gold miners has done that, but it's at the top of this run. And I don't know. It looks a bit like a blow off top to me. We'll see how it completes the turn, but that sure looks like a blow off top. Airlines are up this morning, more of a reflexive bounce because they're just dogs that continue to get beat down. Other than that, we are a market collectively waiting for something. The other shoe to drop, some sort of news, some insight, some clarity. We need something, and we don't have it. I already gave you the checklist of things to look for. Treasuries, intraday, 0-day options flow, headliner news that isn't already a part of the docket schedule. Mag 7 dominance. It's going to have to be something because the S&P and the NASDAQ won't just take off and run on their own. Something's going to be the fuel. So far, we don't have it. So that's what I got, guys. Be careful, be safe. I'll see y'all tomorrow.